So let's start on distressed,
Sure.
because you have a new, I think, third fund,
Yep.
Something over $2 billion.
Yep.
Why did you decide this was a particularly good time to have some dry powder to maybe jump into the distressed area?
Well, look, I've been doing distressed now for over 35 years, and distressed is an opportunistic strategy. And there are moments where distressed is super exciting. There's moments where it's less exciting. And our view is having capital ready to seize on that opportunity always makes sense. And as you highlighted in your opening comments, rates have gone up 500 basis points. Obviously, this week and the last couple of weeks have been pretty big weeks with rates coming down. But the extraordinary thing that we're facing is $1 trillion+ of debt that's coming due over the next 3-4 years. And that debt needs to get refinanced. And as we look at the picture of that, the profile of that debt, we think that it's not going to be able to be refinanced in the syndicated markets. And so we think there's going to be an extraordinary opportunity to provide customized capital solutions to help these companies refinance. And when I look over the different distress cycles over the last few decades, it was a very different opportunity. There was a big recession, there was geopolitical events, whether it's 91, 2001, 2008 global financial crisis. This time, it feels like it's not necessarily going to be a big recession, although it's obviously still out there as a possibility that causes distress cycle. This time it's just the reality of so much debt coming due.
Well, is it in some senses, Glenn, a macro event of having money essentially free for a long period of time, which is pretty extraordinary,
Sure.
globally, not just in the United States. And you come off of that, and there are consequences. That may be the macro event, as it were.
Yeah, look, I think that the inflation that we saw over the last couple of years post-COVID clearly put a major strain on companies. And when you raise rates 500 basis points, that has a big dent in free cash flow. And a lot of companies issued debt a couple of years ago when rates were lower, and debt comes due. And so we look at that profile, again, $1 trillion in the US over the next 3-4 years. It's the highest amount of debt coming due over the next 3 years in any point in the last 20, 30 years in the leveraged finance markets. And there's another 300, 400 billion of debt coming due in Europe. And so I think there's really two ways to play distressed, I think, in this upcoming cycle. One is going to be buying into those companies that you think will be able to refinance the debt, and buying at discounts, and we think make double-digit opportunities there. And then the second, as I said a moment ago, is providing customized capital solutions where you can layer in capital, get security because a lot of the assets are not secured, get downside protection, and then have some upside opportunity.
So the rise in interest rates was a very big story for the business world, 2023. Another big story, actually, was the growth of private credit.
Right.
Every single day we seem to see something new in private credit. You're very active in private credit, have been for a long time. Why is it growing so fast? What is the itch that's being scratched there?
So private credit is an extraordinary asset class. The itch that is being scratched, to use your phrase, is the demand by private equity sponsors and by non-private equity sponsors to get a solution to help their capital structure, either to do new transactions because they're not confident in the access to the syndicated markets, to have a bespoke transaction that provides for asset sales or business improvement, to have flexibility with a partner that you've worked with for years. And the reality is that the syndicated markets, because of the proliferation of CLOs, and the banks withdrawing from the market in a pretty meaningful way post-GFC, but with the increased capital requirements, it seems like it's going to be even further withdrawal. In fact, you're seeing banks do private partnerships with people like ourselves. We have a big partnership with BMO as an example, but others are doing them as well. We think that the banks aren't providing the capital. The CLOs are very structured vehicles, and while they're great vehicles, and we have a very large CLO business ourselves, only certain types of assets fit in there. And so when we look at the private credit market today, the opportunity to invest in the first 0 to 40% of a capital structure, 0 to 45, maybe 50% sometimes, in a multi-billion-dollar company, in an industry we like, with management team we like, with sponsorship we like, and the opportunity to make 10, 11% plus unlevered, I think is really attractive.
So how big could private credit get in your adjustment?
Well,
because to put it in perspective, there were numbers coming out of Apollo, actually, that said it's like $1.5 trillion, something like that, in private credit. the balance sheets of the banks are $100 trillion. Right. So it's come up a long way, but comparatively, it's still relatively modest.
But let's put that in context. The leverage finance market today, the leverage loan and high yield market today is about $3 trillion. That's the liquid market in the U.S. The private credit market today, $1.5 trillion. If you look at the likely demand for private credit, if you take the $2.4 trillion of dry powder in private equity funds, and you assume $5+ billion of deals, there's an enormous demand for private credit. And then when you think about the refinancing, there's about $600 billion of debt coming due that's rated B3 or below that will probably have to access the private credit market. And so you could see the private credit market tripling. And I would say that if it gets to $5 trillion, that's a pretty large market. The investment grade market's 10+ trillion. So it's a meaningful market. And I just see the demand from large pension funds, from institutional investors, from individual investors. You're obviously seeing one of the big trends is accessing alternatives from the retail. We did a transaction with T. Rowe Price a couple of years ago, and we just launched our first product with T. Rowe Price to do a non-traded BDC to give individual investors a chance to buy private credit.
So Glenn, you have this new fund, it's your third, right, but you have other dry powder, right, that you can really put into distressed.
Right. Yeah, so we've been investing over $20 billion of distressed over the last 3 decades, and today we have dedicated funds, but we also manage a lot of capital for separate accounts, and so we have in total over $5 billion of dry powder, and as a practical matter, because of the flexible mandates we have, if there was extraordinary opportunities, that number could flex up from there. And so I believe having that capital to be opportunistic, to be patient, to be selective, to seize on the opportunity will hopefully yield our investors some really attractive returns.